Small caps are quietly starting to lead the stock market, and most traders don't fully understand what that means yet. When small caps take leadership, it usually signals something bigger than a single green day. It signals a shift in market structure. For a long time, the market can be carried by just a few mega-cap stocks. Those names become the engine of the entire market. But when small caps begin to outperform, it tells us money is expanding outward. It's no longer concentrated in just a handful of names. It's spreading into the rest of the market. That expansion often marks the transition from a narrow rally into a broader, healthier phase. More stocks start participating. More sectors show strength and momentum becomes more sustainable. This isn't about hype, it's about understanding where capital is flowing. This is analysis by One Oak Trading, and we're breaking down what this means for the next phase of the market. When small caps start to lead, it changes the personality of the entire market. The market stops being dependent on just a few big names. It starts to become a market where many stocks can move at the same time. That's what traders call market breadth. And breadth is one of the strongest signs of a healthy trend. When breadth improves, momentum becomes easier to sustain. Instead of one stock carrying everything, dozens of stocks start doing the work together. And that usually creates more opportunities for traders. This is why professional traders pay close attention when small caps begin to outperform. It's not noise, it's structure changing. It tells you the market is becoming more confident, not more fragile. And confidence is what fuels continuation. That's how strong trends are built. Small caps react faster to changes in the economy than large caps do. They are more sensitive to interest rates, credit conditions, and growth expectations. So, when the market starts to believe conditions are improving, small caps are usually the first to move. That's because their businesses depend more on borrowing, expansion, and domestic demand. When rates stabilize or ease, pressure comes off these companies. And when pressure comes off, valuations can expand quickly. There's also a seasonal factor called the January effect, where smaller stocks often show early year strength. It doesn't happen every year, but when it lines up with improving sentiment, it matters. Add in the fact that small caps have lagged for a long time, and you get a catch-up dynamic. Money looks for what hasn't already moved, and right now, small caps still fit that description in many areas. That's why this rotation makes sense from a macro perspective. Now let's talk about how traders actually use this information. Because small caps leading is not a signal to buy everything. It's a signal to start watching where leadership is forming. Strong markets don't reward random buying. They reward focus. Traders look for stocks that already show strength before the crowd arrives. They look for higher lows, strong closes, and steady volume expansion. That's how leadership is identified early. Small caps give you opportunity, but discipline decides results. You don't chase strength, you let it prove itself. And you always define what would invalidate your idea. Because risk management matters more than being right. This is how professional traders survive long-term. Now, let ES talk about some of the names and themes that are getting attention in this rotation. Not because these are guaranteed winners, but because they represent where money is starting to look. Think of these as examples of rotation interest, not blind buy signals. You're seeing attention move into areas tied to housing, defense technology, and small-cap growth. For example, housing-related names tend to heat up when rate expectations start to shift. Defense and autonomy names gain traction when geopolitical spending and security narratives strengthen. And small-cap growth names attract momentum traders when confidence returns to the market. These are the environments where leadership often forms before it becomes obvious. Rotation is not about picking one ticker. It's about recognizing the theme. When multiple stocks inside the same theme start acting well, that's confirmation. That's how you separate real movement from short-term noise. This is where psychology comes into play. Markets don't move because of logic alone. They move because of belief. When traders start to believe that risk is acceptable again, money moves faster. And small caps are where that belief shows up first. Because small caps represent risk, opportunity, and expansion. When confidence rises, people move from safety into possibility. That shift doesn't happen overnight. It builds quietly. And then suddenly it feels obvious in hindsight. That's why the early stages always feel subtle. The market whispers before it speaks. Small caps leading is the whisper. And traders who listen early have the advantage. Now, let's talk about what would actually invalidate this idea. Because every strong thesis needs a clear failure point. If small caps stop outperforming and start lagging again, that's your first warning sign. If market breadth contracts and fewer stocks participate, that's another red flag. And if leadership collapses back into only a few mega-cap names, the rotation weakens. That doesn't mean the market is broken. It means the opportunity is shifting, and traders must adapt. Strong traders don't marry a thesis. They follow the evidence. Rotation is dynamic. It changes when behavior changes. Discipline is what keeps you aligned with reality. That's how you protect capital and stay in the game. So now the question becomes, what comes next? If this rotation continues, the market usually becomes more tradable. More setups appear, more sectors participate, and opportunity broadens. That's when traders stop feeling like they have to chase the same few stocks. The market becomes more balanced and more dynamic. You start seeing strength in places people weren't watching before. And that's usually where the best opportunities form. But patience still matters. Rotation doesn't reward impatience. It rewards observation and discipline. You let the market show you where strength is real. And you follow leadership, not excitement. That's how consistency is built. So when you step back and look at the big picture, small caps leading is not random. It's a signal that the market is becoming more confident and more willing to take risk. It shows that capital is no longer hiding in just a few safe names. It's starting to explore opportunity across the entire market. That's how strong trends are built. Not through excitement, but through participation. Not through noise, but through structure. And not through guessing, but through observation. If small caps continue to lead, it tells us this market still has room to grow. And if leadership shifts again, we adapt. Because trading isn't about being married to an idea. It's about staying aligned with what the market is actually doing. That's how you stay ahead of the crowd. This is analysis by One Oak Trading. Please like, comment, and follow.